You need cash to grease the wheels of commerce. Cathie Wood continues her knock on the Fed, saying that money is drying up. We'll also review her comments on Tesla and Ford. And finally, she had a startling statement to say about AI, so don't miss that. Hi, this is Randy Kirk. And, if you like this kind of content, please hit the like button. Then obviously subscribe, hit notify. Great programming coming up. Some news stuff this afternoon, tomorrow morning. A program you can't miss about solar and what's happening in the world, in the United States, what's happening with solar. That's on Sunday morning. You don't want to miss these things. Please hit notify and then join Patreon. That'd be a real help. All right, let's get into it. Cathie spent a huge amount of time on her call talking about the banking crisis and the money supply. I'd say the majority of the call was about those two things. A basic principle of economics, she says, and I agree, is that you can't have low or zero risk money costing more than higher risk capital. Makes sense, right? I mean, you can't. Well, anyway, the Fed has flipped that concept totally on its head. So now local banks are paying far less to their clients for their certificates of deposits and other kinds of deposits than that same customer can turn around and get through money market funds that have virtually no risk at all. So I don't think your bank can afford to give you 3.4% on a 10-year CD. I don't think they can give you 4% for a 2-year CD. And I don't think that there's a chance in the world they're going to give you 5% for a 2-month CD. So everything's flipped on its head with regard to how lending normally works. And the result is the government is basically crowding out the banks from their source of deposits. And that's why you see this deposit outflows is the banks, the local banks, the regional banks, even the national banks, they can't compete with the Fed for these kinds of rates. So what does that mean? Well, that means that some of these regional banks got messed up. The Fed really messed them up. No regional bank 2 years ago would have ever expected, there's no way they could have ever anticipated that the Fed funds rate would go from 0.25% interest all the way up to 5.25% interest in 2 years. It had never happened. Nothing like that had ever happened before on a percentage basis, hardly ever happened before on a pure basis, even thinking in terms of 5 percentage points in that short of a period of time. In addition, there's never been a situation ever where the funds were flowing out of the banks, where deposits were disappearing, to where there was a net outflow, except for very, very short periods of time, and those outflows would be reversed. And when those outflows were going in that direction, when there were more outflows than inflows, that's always going to be in a situation where the economy is in real trouble. So they weren't expecting that either. So what did they do? They invested their money in these 1.5 to 1.7% long-term bonds. And these were things that they put on their asset sheet as their plan was to hold them to maturity. Well, if that's how you put it on your asset list as hold to maturity, then when the interest rates went way up, the value of the bonds went down. And now you have this asset that is sitting on your books that's not worth what it's supposed to be, what you think it's worth, or what the regulators are even looking at in terms of the value. So it crushed these banks. Every one of them, pretty much all of them got hit to some degree, but some of them got hit worse. So as a result, this is where we are today. And one of the things that's happening is money is drying up. So if the bank doesn't have deposits, then they use those deposits in order to be able to loan money. If they can get those deposits at a low interest rate, they can afford to loan money at a low interest rate. If they can't, they've got to raise the interest rates, and that forces some people out of the game. So for instance, let's use a car as an example, since we're in the Tesla business. So if I can buy a car, as I did, my Model Y, at 2% interest, that gives me a certain amount per month that I have to pay. But if all of a sudden it's 7%, it's a huge amount more that I have to pay per month. So that pushes me out of the marketplace. Possibly I'm not able to borrow that money. Well, then that bank loses that customer. They no longer have that activity, that revenue taking place. And so they're losing on both sides. They don't have the deposits. They don't have the lending revenues that they did have. So this is drying up money. The Fed is basically ignoring the fact that M2 is dropping. It has dropped in the first quarter, and it accelerated that drop in March. I don't think we have the results yet for April to know. According to Cathie, all these quotes are from Cathie. So while they're watching this M2 dropping, they're also apparently ignoring the fact that the cost of credit default swaps is going up radically. So a credit default swap is basically where a bank has insurance against bankruptcies of the loans that they've got out there. So when the risks get higher, their customer risk gets higher, they have to pay more for these credit default swaps. This is a signal that all the loans, that their overall portfolio is getting riskier. So that means the banks have less to lend. They don't have, the customers can't borrow. It's costing them more money to lend it because of the credit default swaps. So they're not lending as much. And it doesn't take too much to trigger a complete shutdown in cash flow through the system. I've been through, I think it's 10 recessions now as an adult. I've written books on one book on recessions. I've studied recessions backwards and forwards in order to be able to write that book. And in the course of writing it, I looked at all these different types of recessions. And I can clearly remember that the worst recession I ever went through was the recession where there was no cash. Because what happens? I happened to be a wholesaler at the time. So my customer, the retailer, he's not getting any business in the door, and or he can't borrow more money from the bank. So he can't pay me. I got a bunch of retailers like that aren't paying me. And so a lot of wholesalers use accounts receivable financing. All of a sudden, those receivables are getting older and older. So not only do you not get paid by your customer, but you also have your loan go down, the total amount of capital that you can borrow go down, because a lot of your asset is now not usable. It's over 90 days. So now I can't pay the manufacturer, he can't borrow more money either, et cetera, et cetera. And this is where you get into a complete stalemate, and there's no way to get out of it because you can't sell your way out of it. You can't do sales and specials and promotions because the consumer doesn't have the money either. They can't borrow the money either. So it's a complete catastrophe until it just kind of washes through. That's what usually happens. It takes months, but it may wash through. Well, this is the kind of recession we might be headed towards if the Fed doesn't start fixing this massive inversion, this complete nonsense where higher risk money is costing less than low risk money. It makes no sense at all. So the headline numbers look good today on unemployment. I even reported in my Friday night report that the numbers were good. And I was kind of surprised that the market reacted so well to what was not a very good report. However, Cathie took a little deeper dive, and that's why I appreciate Cathie, because she takes these deeper dives. So she said that there was a bunch, some weaknesses we needed to look at. The March employment number a month ago was revised downward. Last month, it came out at 230,000 new jobs. It wasn't revised down to 225 or 220. No, it was revised down to 160,000. That is a massive revision. And at the same time, first-time claims for unemployment insurance were revised upward. They were at 196. They weren't revised upward to 200 or 210. They were revised upward to 246. In addition to that, she points out that the layoffs are up 170% year over year. So you put all that together, and yes, there's still a lot of jobs out there, and there's only a few people looking for those jobs. And the unemployment rate is 3.4, which is the lowest it's been since 1969. So there's a lot of room left in the economy to absorb these kinds of layoffs and to absorb the fact that there may be more people going, into unemployment, at least for a time, but it looks like there's still jobs to absorb them. So we could have this famous soft landing, or possibly we stay positive for the rest of the year in terms of the economy. However, once again, one of the good numbers that came out this week was was automotive. Both the automotive sales were up, revenues were up. Ford and General Motors had good earnings calls. Both of them were giving good guidance. Cathie says, "Watch out." And I said this actually in my either Wednesday night or Friday night, can't remember which one. A lot of those cars that are being sold right now, that's from pent-up demand. Last year, there was chip shortages and all kinds of reasons why the car companies weren't shipping. People were waiting. They were holding on to their cars longer. This could be pent-up demand, and it could be, almost certainly is, to some extent, inventory fill-in because the pipeline got drained during the shortage. So as the retail lots fill up, we'll see over the next month or two, is there a lot of inventory now building up in these lots? All right. What did Cathie have to say about Tesla? Well, I'm sorry, I forgot one thing. She mentioned commodities. All the commodities were down. Every commodity she follows is down except for silver and gold. That would indicate a general flight to safety. That flight to safety is what we're also seeing in the Fed, people taking their money out of banks and into Fed funds. So, all of these things look like a flight to safety. Cathie adds into that flight to safety Bitcoins. I'm not ready to join that team yet. I'm still not a Bitcoin fan, but maybe you do. She's saying this is proof. The increase from 19,000 to 29,000 is more proof that people are now seeing Bitcoin as a safe haven. So maybe not. Okay, what did Cathie have to say about Tesla? Well, she reiterated Tesla's game plan. She just kind of gave it. And she's like, okay, what we're going to do is we're going to sell all the cars that we can possibly make between now and the end of the year. And if we have to cut margins to 20%, we're going to do that. Cathie said, hey, how can it be any smarter than that when you cut your margins to 20% and your margins are still higher than all your competition? So she was totally on board with it. She believes it's the right move. She also believes, as I do, and I think any smart person does, that Tesla is cutting their cost of goods. As they make more, the overall cost of goods reduces. The amount of capex that they put into those buildings, into the two new factories, that is absorbed more and more, and their overhead as a percentage of their revenues goes down. So in every aspect, if everything stayed equal, their margins will go, if they didn't raise prices or change prices at all for the rest of the year, as the year goes along, their margins will get bigger and bigger just from those lowered costs of goods and overhead. So what did she have to say about Ford? Well, she didn't have much good to say about Ford. She said she listened to the call. She couldn't believe it. She says, it looks like Ford has capitulated to the short-term stockholders, that they are going after as much profit as they can possibly get right now, that they are anticipating continuing to milk all of their investment in ICE hardware and all the tooling and everything else that they have. They're going to continue to milk that as long as they possibly can, expecting that they'll still sell ICE cars in the 2030s. She ridiculed that, as I do. That does not sound like a very good plan to me. And it sounds like an emphasis switch from a massive effort to ramp up on the EVs and more emphasis being placed on their legacy products. Okay. Finally, what did Cathie have to say? Really important here. What did Cathie have to say about the AI and the large language models? She believes that there will be a large impact on productivity worldwide, in the United States, across industries, and that productivity increase will come immediately. This is not something that will take years to play out, but rather across every business, across every industry, whether it's doctors, lawyers, accountants, manufacturers, wholesalers, it doesn't matter. Everybody will be able to immediately get productivity gains, kind of like on the order of when we went from typing letters, and then within a very short time, we went to email. The productivity increase was huge. So this productivity increase will also be huge, but it'll be even faster than that one. taking no time at all. IBM has already announced that they're going to hold off hiring any more back-end employees, office back-end employees, because they think AI will pick up any slack. They won't need to hire any more people to work in these clerk positions that can be handled by ChatGPT and others. She also believes that a lot of the activity, a lot of the productivity is not going to come from ChatGPT itself. She believes that there's an awful lot of folks that are using special data sets. They are using special tools on top of ChatGPT or on top of these large language models, and that these will be the really big winners, is the ones that can take advantage of the breakthroughs that have taken place and add their own special uniqueness to it. And they will really be the big winners in the short and in the long term. So I agree with that. So that's what Cathie Wood has to say. If you didn't, I didn't say anything in the beginning, but I typically do this. Cathie reports once a month, typically on the day when the unemployment figures come out. And I follow up with her report with this shorter report so you can get the information instead of 50 minutes. Hopefully you can get it in 15. So hit the like if you liked it. So that'll let me know to do it again next month. For sure you want to subscribe, hit notify so you can learn about, and by the way, look down in the information below and you can see some of the programming that's coming up over the next couple of days. Really some great stuff coming up. And then of course, I'd love to have you participate in Patreon. It's only $5 a month. It's been great talking to you.
Click the link below to get your paperback, Kindle, or audiobook now.